All right, so let's take a look at a financial statement called the Statement of Stockholders' Equity. And so we're given a series of facts here. Do notice that we have a statement of stockholders' equity for a company called Architect Services for the year ended December 31st, 2018. All right, so we have several ingredients here. You know, we've talked about a statement of retained earnings, and we said that when we're trying to calculate retained earnings, that we want to take, the beginning earnings, add to it net income, and then subtract out dividends. But what if we wanted to a financial statement that could calculate all changes in equity? Now, we've made comments before about the fact that retained earnings transactions are numerous. Every time a company makes a sale, records an expense, these kinds of things, we change retained earnings. So it's constantly changing. Common stock rarely changes. So if we don't have any common stock sold or issued, as we call it, there may not be any changes to this. So notice we don't have any figures here. We have to plot everything. Now, I also want to tell you that the way I'm going to do this may not be the way if you were to do an assignment like this in an online setting. Okay, I might put some numbers in some places that are not exactly right, but I'm doing that so that we can kind of follow along a little bit easier. And I think you'll see what I mean. Okay, so let's look at the scenario here. It says on December the 31st of 2017, the credit balances, and that's a good point, these are credit balances, of common stock and retained earnings accounts, looks like I've got some odd spacing here, that's okay, were $30,000 and $18,000 respectively for Architect Services Company. All right, so we don't have anything in our little box here, so we have to put it there. So it says that the balance for common stock is $30,000, so let's just go ahead and write that in. All right, and the balance for retained earnings is $18,000. So at December 31st, 2017, then, total stockholders' equity was $48,000. All right, and that's all we have to do. And I can guarantee you, that we would need all three of these boxes filled out. Okay, so but if you have this for real, you need to follow the instructions that you're given. Okay, it's stock issuances, again another odd spacing issue, for 2018 totaled $6,000. And then I see it's going into dividends here. So I'm going to focus just on this $6,000. All right? And so I'm going to plot $6,000 here under the issuance of stock for common stock. And what I'm going to do now is I'm going to recalculate total stockholders equity. All right? So we want to understand that a couple of things here. And again, I can't emphasize enough, you have to do this based upon what the instructions are, although I think I'm on the right path here. So 30 and 6 is 36 plus 18 gives us our 54 here. All right. Now, it says that they paid dividends. It paid $9,700 cash toward dividends in 2018. Okay. And dividends is our next item. And we're going to actually put this because dividends are not a part of common stock. Dividends lower retained earnings. So what we're going to do here is we're going to plot this $9,700 right here as a negative. And then, it's pretty easy to add 48 and 6. But after that, we start getting a little dicey. So let's take our $54,000 that we have right now. And then I'm going to subtract this $9,700 in dividends. And we have $44,300. And that is our new balance, not really, but for purposes of illustration, that's what I want to show you. Okay, We paid those dividends and it went down by 9,700. And then, let's see here, what else do we have here? Let's see, where can I move this to? Yeah. It says, well, let's see here. It says the company had net income of $29,900. All right. So what we want to understand is that net income flows, whatever we don't pay out in dividends goes into retained earnings. So this $29,900 from the income statement for net income, we're going to plot that right here, $29,900. And then so we're going to then add that. Okay. And so we come up with 74,200, which if we think about it, what we would be talking about here, we can just drop this 74,200 down again, and then we can come over here and add the 30 and the 6 together, and that's 36,000. And then I want to do, that's the 74,200 that we have right here. We could do this a couple of ways. I'm just going to subtract this 36,000 out. And I'm going to get 38,200. And just looking at this, we can see that it's right. I mean, I don't encourage you to do math in your head, but 36 and 38 is 74, and then there's the other 200. But we probably ought to be careful. So let's go ahead and clear that out and take 18,000 minus 9,700 plus 29,900 equals 38,200. So that is correct. One little point I want to make is that normally, you know, this is fine. What we did right here is fine, and then we did the stock issuance. If we're really thinking about this sequentially, what we would normally do is calculate our net income and then determine, okay, this is our net income, $29,900. How much do we want to pay out of our earnings to the company owners by way of dividends? So normally, you know, we would maybe reorganize these here, at least conceptually in our minds. Now, for the purpose of this statement, it doesn't matter, okay? But there's our answer, 36,000 in common stock, 38,200 is our new balance in retained earnings, and our new balance for total stockholders' equity, 36,000 plus 38,200 equals 74,200. And that's all there is to it.